Hi there everyone, and welcome to our end of June edition of On Track. It's July the 19th as I record this on a beautiful Noosa day. I apologise for the delay on this one. I'm aiming to get these out by about the middle of the month. Two reasons for the delay. This time, one, we've just been away to our conference, and two, just waiting for some numbers to come back on the June 30 returns, which I'll get to, which are very good. So let's get into it. First, a general advice warning. This monthly briefing is designed for clients of McGregor Wealth who are investing in particular in the care portfolios. For anyone else who's watching, you're welcome to the information, but please contact us to put it into perspective for you. So what we're going to cover, as always, we're going to have a look at some of the important news to the market over the last month. We're going to put that in context to what it means to you. Quick update on each of the markets and put it in perspective about what that may mean to your strategies at the moment. So let's get into the highlights. And in Australia during June, we had another rate cut from the RBA. So interest rates now at record lows. We have a cash rate from the RBA at 1%, and we're seeing term deposit rates fall below 2%. Government bond rates, just about 1.6%. So these are record low rates, and it's creating quite a challenge for those who've got too much money in cash. Not necessarily our clients, but it's a low return environment, and I'm going to talk about that some more as we go through. The market continued its rebound. We're almost at a previous high, and you'll see it at the charts in a minute. In Australia, that is, when I come to that, the previous high was in October 2007. That's now nearly 12 years ago, so it's a long time to get back to that. We haven't broken it yet at the time of recording, and if history's any guide, it'll normally bounce around there for a while as people get a bit nervous before it resumes the historical track of always continuing on above previous highs. Inflation is now below the RBA targets. Inflation target is between 2 and 3% for the RBA. We've fallen just below that. That means that is partly why the RBA cut the rate. The other reason they're cutting the rate is they don't want our Aussie dollar to go up too much. And I'm going to talk a bit about the Aussie US dollar towards the second half of this presentation. Our GDP growth is 1.8%. It's the weakest it's been since the GFC. So it's not a recession, although some people are talking about how we're having a per capita recession. If you divide it by the population, then we're slightly in a recession. There's no doubt we've got slow growth. So it's fascinating times. We've got slow growth plus low interest rates. On the positive side for Australia, there's a few things. Iron ore prices are rising strongly. That's helped the BHPs, the Rio Tintos, etc. We've got a bit of a rebound in the property market, or a floor and return of property development. And around the country, state governments are starting to spend money on infrastructure. And it's very important. One of the key balancing items in a good democratic capitalist system is when the economy does slow, the government kicks in, or governments kick in with some infrastructure spending. So it's good to see that happening. All those things should see us see out without a recession. You never know, we may fall into one, but it's not looking likely at the moment, although it's always a chance in a low growth world, depending on external shocks and the like. Internationally, we saw the G20 meet. That's the top 20 economies, the countries in the world, and we saw them sort of announce a bit of a truce on the trade war. It's sort of stuck, the trade war. China's digging in. They're very good at playing long-term games. They're not subject to having to account to the people so much in terms of elections anyway. So China's digging their heels in. Trump's digging his heels in. I still think Trump would like to make a deal, some sort of meaningful deal before the campaign starts. He'll probably claim victory no matter what. He's very good at distorting or putting spin on whatever's happening to make it sound like he's responsible for all the good things. So watch that space. In the meantime, we're still seeing US growth about at its long-term average, sitting at about 3.1% a year, average of 3.2. So these are pretty good numbers compared to the rest of the developed world. I've put down there China's growth, which is 6.2%. And keep in mind, China's the second largest economy in the world. It's still got a way to go behind the US. But 6.2% of economy that side is still good growth for the world. And we're seeing global growth around 2.6%. Excuse me. But the global growth is a story of two things. or three things really. The developed world, you've got the US doing okay, better than the global average. You've got the developed world, that's China, India, and a lot of emerging markets doing better than that average. And you've got the first world countries like Australia doing a little bit below. And then you've got Japan and Europe doing not much at all. We are seeing the gold price rise, and that's on the back of the trade war, but also the back of continuing lower interest rates and a continuing printing of money. So people see gold as a quasi-currency. So, this is why we have gold in the portfolios. It's as a store of wealth, and it's a contrary measure normally, although it was interesting. During the month of June, we saw gains from gold as well as gains in all the share markets. So often gold is up when other things are down, but this month they were all up together. And I'll get to those returns in a minute. Just a reminder, our framework, we do believe the market moves through different stages. They're not perfectly predictable, but a framework helps us to make decisions about how we manage your money and our money. So the market most of the time is in this what we call the wall of worry, and it sits there 80% of the time. Occasionally it runs off and has a boom, as we had in the 2005 through to 2007, and ultimately and inevitably following a boom there's a bust or a correction, as we had in 2007, as we had in 1987, and so on and so forth. Our theory goes that it's impossible to predict short-term market movements. That is, drops of up to 20%. They're perfectly normal. We get those 5 to 20% drops every 3 to 4 years. We can't predict them, but we do want to avoid too much damage during the boom and the bust, which is when most people do their damage by getting too carried away in the boom and investing in too risky, borrowing, concentrating their investments, and then panicking when the bust comes. If we can manage that for most people, you get the beauty of the long-term returns that equity markets deliver, which we'll revisit. Just revisiting our concept here this month on the way most investors mess it up, because most investors do underperform their own investments. In other words, they get less than half the return that they could have got because they do silly things at the wrong time. And that's that during that boom, they get greedy, they leverage up, they concentrate their investments. During the bust, they panic. We use mess it up for the acronym on all these things, following the media. Media's negative 90 to 99% of the time, whereas the markets are positive 80% of the time. The two I want to talk about today are the emotions and illiquidity. And just quickly, but ultimately emotions drive us because we're basically still got a prehistoric brain. When we hear a rustle in the grass, our instinct is to freeze or flight, to run. And unfortunately, when we hear a rustle in the markets or the world economies, our instinct tells us to run, and it's exactly the wrong thing to do. Because normally when there's bad news, we're better off to be buyers. When there's good news, we're better off to be sellers, or at least rebalancing. So our emotions are the exact wrong way around. All the modern portfolio theory rests on the assumption that markets are rational markets are efficient and investors are rational, but I'm yet to meet in 35 years in the markets a rational investor. So we're all flawed because of our prehistoric brain. So the framework that we used for many, many years allows for that. It acknowledges it. We talk about it with you guys when we sit down, and we're ready for the downturns. We can't predict them, but we know they're going to come at some stage, and we know what we're going to do. One of the ways people lose money, one of the ways people mess it up, the I in mess it up, is the illiquidity. And that just means they don't have liquidity when it comes time to when they need it. So there is only three ways that people lose money in the share market. The first is if they panic and sell when markets are down. The second is if they have to sell when markets are down. And the third is they're not actually diversified. So using our care process, we take away all those things, and we solve the illiquidity problem by having an appropriate amount, usually up to 4 years, in reserves for our retired clients, and for our accumulator clients, those still working, we're dollar cost averaging in. So we're not doing big lump sum borrowings, we're just buying into the market gradually, which means we buy the corrections. So those are the ways we manage those important things. let's get in now to some of the market segments, and these numbers are to the end of June. And ultimately, they'll be the ones you compare with other returns and funds. And it was a good month, June. So you can see the chart here. Aussie Shares, the 1 year number at 11.24%. Now, I deliberately show these left to right because the long-term historical is actually more important. We get so fixated on 1 month numbers in most of the media and most returns that we forget the job of the shares in your portfolio is to give you a good long-term return. We know they're going to be volatile in the short run. So 3.63% was an actual very good month. 11.24% a good year, and it's a good 3 years as well. Two charts here. The top right chart shows 1 year, and it shows, it's interesting. The year is a story of two halves. We had a peak there, which I've marked on the 29th of August at 6.3. We then dropped down to around about Christmas time. We're up a good 10% since Christmas, but we're only up about 5% since August. And this is the volatility that is soon forgotten. So at the moment, we're all counting the good returns, but they were from a high base. Still, 11.2% for the year is great returns. The chart down the bottom shows, excuse me, going back to 2007. So it shows the last bit of the boom where we're going straight up, and then it shows the massive drop from nearly 7,000. It was about 6,700 down to close to 3,000. And the slow climb up the wall of worry since. Now that climb has been steady. Those lines are parallel. And this is why we've seen the market move through cheap to fair to a little bit expensive, but in a steady increase as companies increase profits, which is what they do. Our assessment of the Aussie market at the moment is fair to expensive. It doesn't mean it's a sell. It just means as it gets a little bit expensive for any new cash going in of significant lump sums, we may delay investing that till it drops back to fair. No change for any $1 cost averaging, and we would be rebalancing as per normal. So within the absolute normal range, nothing to be worried about at all. Won't surprise if there's little bits of corrections in the second part of the year. But the challenge for everyone at the moment is with interest rates so low, where do you put your money? If not in shares, do you want 1%, 1.5%? And the answer for most people is no, which is why during the wall of worry, every time we get a drop in the market, it very quickly bounces back as people realise that shares are delivering, Aussie shares in particular, deliver about a 5 to 6% grossed up return just from the dividends alone. So a healthy place to have a good part of your portfolio, as most of you do. Let's have a look at US shares, and US shares had a good month, up 5.63%. Some of that is still a result of the Aussie dollar, and in the charts here I've shown two things. The top right-hand chart shows VTS, which is the exchange traded fund we have in the Care diversified portfolios that represents US shares, and you'll see it's been a good year, but not a spectacular year, but a good year, and that's resulted, it's been a very good year. It's resulted in 19% in Australian dollars. The chart down the bottom shows this market, the S&P 500, which is the US index in its own currency in the US, and you can see in the US it's only up about 700 points, which is so it's only up, it's only about 200 points. So 200 points, which is a little under 7% on the market here, while we're up 19%. That difference is purely the drop in the Aussie dollar. So when the Aussie dollar drops, all our overseas investments do better than what they're doing in their own country. The reverse also applies. When the Aussie dollar goes up, international shares take a bit of a haircut, and I'll talk more about that a bit later. We rate the US market at same rating as the Australian market, between fair and expensive, so not too hot, not too cold, so a reasonable time. And historically, we expect that to return, about inflation plus 7% is what the market has returned over time, and consistently good returns there in the last decade. Keep in mind that last decade is all from the lows of post the GFC. US small caps have had a lackluster year in Australia. We've had a return of pretty much square. In the US, the bottom right-hand chart here shows the fact that in the US small caps have actually gone down. That downward trend has been sheltered in Australia by the fact, once again, of the Aussie dollar going down as well. So that's meant we've been square. This was a pretty healthy correction in the US because US small caps had a tremendous run. IJR, which is the company we hold, which is the exchange traded fund that we hold in the diversified funds, had an amazing 5 years, still sitting at 15%, nearly 16% over the last 10 years. Those numbers have come back down a bit thanks to the correction in the last year, which we view as very healthy. We now see US small caps as fair value. We do see them as an important part of the portfolio because in the long run, small caps do outperform larger caps in the long run. They can have some more volatility in the short run. Then we go to global leaders, and that's represented by IOO in the portfolios. It's had a 1 month performance of 5.1%, a 1 year performance of 14.4%. So good solid numbers again. But once again, you can see the return in Aussie dollars is far better than the chart down the bottom shows the return or the graph for the 12 months in its home territory of the US. And over there, it's only up, what do we got? About 5% compared to about 14% in Australia. So all the rest is the currency. So I can't reiterate that enough. So one of the good things about the Aussie dollar falling is all our international shares make more money, particularly the US denominated. Emerging markets, a much better month as the trade war truce was sort of announced, up 4% for the month, nearly 5, up 5% for the year. So they've rebounded over the course of the year. Currencies helped a bit here, but keep in mind, a lot of the emerging markets are in their own currencies all around the world. And once again, we have emerging markets in the portfolio because in the long run, they will provide an outperformance purely because those emerging markets like China, like India, like Vietnam have a higher growth rate than the developed world. So all other things being equal, there'll be some good growth come out of those. More speculative, so we only have smaller proportions of emerging markets and small companies in the portfolios. The bulk of the share offering is Aussie shares and US shares because they're proven and steady economies. But these other smaller holdings are equally important for diversification and for long-term growth. So our assessment here is still cheap. We do think emerging markets are cheap. So and they play an important part in the portfolio. So let's have a look at the dollar, and I've put in two charts in here. The chart on the left shows the dollar over the last 12 months. So we started 12 months ago at the start of July at about 74 cents, and we've wiggled down to as low as about 68 cents, and we're sitting just above 70 cents at the moment. So that's been in response to our interest rates falling partially to the point where our interest rates were lower than the US rates. So that causes money to go back to the US, which causes the US dollar to rise. And the US dollar has risen against most currencies around the world. Now, they don't want that to keep rising too much because if the US dollar rises too much, in the same way as if the Aussie dollar rises too much, that makes it harder for people to compete with imports. So the challenge we get in Australia is if we have a high dollar, while it's good for when we go overseas and we can buy more money with it, it's harder. It means all our imported goods cost a whole lot more. And it's the same for the US. So they may start dropping interest rates coming up as well because they don't want to see their dollar get too high. The challenge around the world is as all developed countries around the world drop their interest rates and rates get closer to zero all around the world, not everyone can drop their currency. So as all the currencies, you can't have all currencies drop against all other currencies. And this is why we're seeing the emergence of gold, which is effectively a currency in itself. We're seeing gold prices surge at the moment because they're saying that's a store of value. So Aussie dollar low, what that means is our commodities now become very competitive. Combined with seeing iron ore prices going up, it means our exporters are doing really well. So this provides a bit of a salvation for Australian companies who are exporting because they get most of their stuff they sell in US dollars, so they're actually getting more Aussie dollars for their exports. So it's a good thing. It's tougher if you're traveling. If you've got any trips planned to the US, it means our humble Aussie dollar doesn't go quite so far. So there's always winners and losers around currency. In the long run, it washes out. Extremely hard to predict currencies. Many people make attempts, very few get it right. We do feel we're now towards the bottom of the range, and we do feel that as growth continues in China and India and places like that, We may see commodity prices like iron ore, gold and others be fairly strong. And historically, periods of strong commodity prices, and you can see that in the chart on the right, the rise in the Aussie dollar from 48 cents all the way through to $1.10 came about when we had strong commodity prices. So if commodity prices do start to become stronger, and that is a distinct possibility, we may see the slow rise in the Aussie dollar as well, and that will affect our portfolio decisions. None of them are ever drastic, but they affect the way we rebalance and what we do. So let's have a look at performance, and the numbers are really good. The numbers are consistent with our planning guidelines when we're doing your plans, which is nice to see. They're almost textbook consistent. So if you see the targets on the right there, a balanced target for the balanced fund, we're looking at inflation +4. That's certainly been delivered across all those periods there, 1, 3 and 5 years. And the difference between the core funds, so the core funds are the funds you have as your core fund. The care returns down the bottom are when you include the active and the enhanced returns in there, and they're in most cases slightly higher, and we aim for about 0.5% extra there, and that's all being delivered. So a balanced fund over the last year, for instance, in the care balanced, about 8.6%. Good numbers and consistent with the plans that we use, which is nice. And we see that because we've got very much an index approach for 70% of the fund. We expect these numbers. It's interesting, I had an investment committee meeting yesterday with GPS, and these funds are sitting in the top 10% of their peers, and they're sitting consistently up in the top 20% compared with industry funds, which is very pleasing. That tells us we're doing a good job relative to our peers. So let's have a quick look at property, and we're still seeing big downs for the last year in Sydney and Melbourne. It's slowed to almost a stop. It does feel like the market's bottoming. So you'll see the change month on month here, and these figures are to the end of May, is flattened out. So the drop there is flattened across Sydney, Melbourne and Brisbane. And reports we're getting in from people buying around there and agents we know is that it looks like the market's bottoming. Doesn't mean it's going to go up anytime soon, particularly in Sydney and Melbourne. Brisbane we still think is very good buying in particular areas for those where property suits their strategy. And property markets look like the downturn has stopped. Never any guarantees, of course. And keep in mind, they're all different as well. So even in the last year, we've still seen some gains in Hobart and Canberra, a little bit in Adelaide, even as the other states came down. And Brisbane, fairly steady, really. Our friends at Herron Todd White, who put out their National Property Clock, so their June report, which is freely available online, sort of the changes there are in orange. So you can see they now have, interestingly enough for people like me and a lot of you who live on the Sunshine Coast, they believe the Sunshine Coast houses at the peak of their market. I've seen others that still argue it's on the rise. There is no perfection. No one has a perfect crystal ball on this stuff, but a good framework from experts is always an advantage. And the housing market that we do like the most for people that are in the market for investment property is Brisbane. We do prefer capital cities. We tend not to speculate into the regions, and Brisbane is certainly well poised amongst the experts, and we share that opinion. They've got Sydney and Melbourne as still falling, so they haven't reached the bottom there. They certainly show Perth as at the bottom of the market, and some experts we see and talk to believe Perth is also good buying at the moment. That's houses, units, much the same. It's interesting, it still shows Sunshine Coast rising for units. For those of us on the coast, shows Brisbane at the bottom of the market. So that's suggesting that the oversupply that we saw, particularly around inner Brisbane, seems to have been absorbed. So once again, Brisbane looking like a reasonable time for those with a long-term view to buy investment properties. So let's put all that into perspective, as always, using our framework. What are the current conditions mean to you? Yeah, a little bit expensive, but it's still steady as she goes. Yeah, regular rebalancing, stick with your plan. For those that are looking to take money out, it's not a bad time to be doing that while it's higher. And I'll give you an example. If you're thinking about buying a car in the next couple of years, whenever the markets have had a good run like this, it's not a bad time to take some money out, ready to do those types of things. when we do this framework, it's certainly not meant to be a trading system. We'd never advise selling even when markets get a little bit expensive, because often that's the launch pad for some of the best returns you'll ever get. Markets eventually go from expensive to that boom, and that boom can last anywhere from 2 to 5 years, and they are the best returns you'll get. The whole reason for this framework is to help us manage our understanding of the markets and not do sort of silly things. So as always, there may be better times to buy or sell, as always. For those that put money in the market before June, we haven't invested that yet quite deliberately. We suspect there will be some dips where we can probably buy that better. For all those people, you have money already in the market, so you'll benefit if it goes up. For those on dollar cost averaging, you just keep chipping away, no reason to change anything. And as always, if the market gets a bit expensive, we've always got the option to average in new money. So at the moment, for any clients who are new to us, we're averaging in from the current levels. But if the Australian share market dropped below 6,300, which we deem to be very fair value, we'd be happily putting most of that money in. And anything below 6,100 would be an absolute bargain. Good time to rebalance, and we do that as we sit down with you, and the portfolios themselves are rebalanced regularly by the investment committee, and as always continue to review. So just reinforcing our process as always, and it does rest on our principal value of you should have an exciting life and boring money, not the other way around. In my 35 years of experience, I've seen that exciting money tends to lead to money being blown up and not making money. So as always, goals first, based on who and what's important to you, and a portfolio designed to meet those goals. As I said, the portfolios are delivering in line with those planning goals that we have and consistently, which helps us achieve the targets that we've set. We do take a long-term view, and once we manage all those things and make sure people don't make silly decisions, then it gets down to diversification, having plenty of diversification across your portfolio, the right asset allocation, and just enough liquidity to ride through the ups and downs that are inevitable. For most of our process, we do like using low-cost index. That's seen us, outperform most of our peers. 80% of our competitors that are in the managing money space try and be very active. We're seeing them struggle to get returns that pay for their fees. The beauty of an index approach is you get the index return, and we're seeing our approach sit comfortably always in the top quartile, and for some of the funds in the top 10% of other funds. And it's due to three main things. One of those is low cost, the other is the index-like returns, and then the decisions around the edge where we do use some active managers, like in the fixed income space, those decisions have paid off. We do protect against short-term volatility for our retired clients, that is with your reserves, and for our dollar cost averaging clients, that's with the dollar cost averaging. So they continue to be the key measures that we protect against that short-term volatility, along with rebalancing regularly, both within the portfolios and when we sit down with you to top up the reserves. That's the end of this month's presentation. I hope you're having a great July. I look forward to talking to you next time I talk to you. And if I don't talk to you before next time, I'll be talking to you next month, and it'll be interesting to see where we're at that stage. Will we have broken through the previous highs, or will we still be bouncing around? Who knows? I will always make no attempt to predict the short term. It's completely unpredictable. Have a great day. I hope you enjoyed this. Keep the feedback coming. Let us know if there's any issues you'd like us to address, any worries you have, and I'm sure others have those, and we can talk about some of those as they come through.